Today we are busting some of the biggest myths about the stock market that I hear all the time. If you have ever been afraid to invest because of something you heard before, this video is for you. Let's get started. Hello everyone, my name is Ankit and I'm a financial data scientist. And on this channel, we talk about everything related to finance. So in today's video, we will be debunking the 5 top myths that I hear about the stock market all the time. Myth number 1, you need a lot of money to start investing. So this is one of the most common misconceptions out there, but it is just not true. You don't need thousands of dollars to get started in the stock market. In fact, thanks to low-cost savings plans and fractional shares, you can start investing with as little as $10. So a lot of brokers offer something called a savings plan where you can invest with as little as $10. How does it work? They buy something called fractional shares, where you basically buy small portions of big companies like Apple, Google, Tesla, Amazon, or whatever you like, without needing to purchase a whole share. So even with just a little bit of money each month, you can start building your portfolio and watch it grow over time. Remember, investing is not just for the wealthy, it is for anyone who wants to grow their money, no matter the starting amount. Myth number 2, you have to time the market perfectly. So this one can scare people off, but it's a huge myth. Many people think that you need to predict the perfect time to buy or sell to be successful in the stock market. But here is the truth. Even the pros can't perfectly time the market. So instead of trying to predict each and every move, the best approach is to just stay consistent. I'm not saying that there is no benefit if you are able to time the market, buy low, sell high. Yes, that's a good strategy, but it's very difficult to execute it consistently. A much better approach is invest regularly no matter what the market is doing. This strategy is called dollar cost averaging, and it helps you smooth out the ups and downs of the market over time. By investing a set amount of money each month, you buy more shares where the prices are low and fewer when the prices are high. So it takes the stress out of the market timing and keeps your emotions in check as well. Myth number 3, the stock market is just like gambling. So this one I hear a lot and it couldn't be further from the truth. Yes, both gambling and the stock market involve risk, but they are not the same, not even close. Gambling is based on chance, while the stock market is based on ownership of real businesses that generate profit and grow over time. When you invest in stocks, you are actually buying a piece of a company, a share of its future earnings. If the company does well, your investment grows. So over time, most well-established companies will grow in value, especially if you have done your research and invest in companies with strong fundamentals. While the market has its short-term ups and downs, historically it has gone up over the long term. Unlike gambling where the odds are against you, investing in the stock market rewards patience and informed decision making. Myth number 4, the stock market is too complicated. So let's be real, the stock market can seem overwhelming at first, especially with all the jargon and technical charts here and there. But here is the good news. It doesn't have to be complicated to be successful. Yes, you need to do a lot of studying before picking individual stocks, or even more if you want to become a trader, you have to learn technical analysis. But one of the simplest ways to start investing is by using index funds or ETFs. So these funds allow you to invest in a broad range of companies, so you don't need to worry about picking individual stocks. Let's take the example of S&P 500 index funds. So this will invest in the 500 biggest companies in the United States, and it is a simple low-cost way to get exposure to the entire US stock market. Instead of trying to figure out every detail, focus on building a diversified portfolio and stick with it for the long term. The market, as I mentioned, rewards patience and consistency. Finally, myth number 5, you have to be a financial expert to start investing. So this is a big myth and it keeps a lot of people on the sidelines. While it is true that some investors dive really deep into research and analysis, but you don't have to be that investor. Thanks to modern tools like robo-advisors and automated investing platforms, which by the way, a lot of mainstream brokers also offer. They offer you the option of automated investing. You can start investing with just a few clicks. And these platforms create a personalized investment strategy based on your goals and risk tolerance. So they take care of the complex stuff, so you don't have to. So there you have it, some of the biggest myths about the stock market debunked. The stock market isn't just for the rich. You don't need to time the market perfectly or be a financial genius to succeed. The key is just to get started, stay consistent, and focus on the long term. Thank you for watching Dimes to Dreams. If you enjoyed this video, please hit the subscribe button and bell icon below, and I will see you in the next one. Bye-bye.